Hello, everyone, and welcome. My name is Elliot Gu, and this is a deep dive investing special stock market summit entitled Avoid Pitfalls and Maximize Profits in a Late Stage Bull Market. It's just gone past 7 p.m. here on the East Coast, and we'll get started here in just a minute. Just waiting for the last few participants to log on. I do appreciate you very much, all of you joining us tonight. I am joined by my colleague and co-founder of Deep Dive Investing, Roger Conrad. Also, you'll notice on your screen, hopefully you can see my slides pretty easily, but you'll notice on your screen that website there, https deepdiveinvesting.com/death of the stock market. That's a website that we just published earlier today that is a pretty detailed research report concerning some of the major trends we're going to be talking about in tonight's summit and in tonight's webinar. Also, some of the techniques and strategies we employ in deep dive investing. And that is available. If you go there, it's free of charge to check it out. It's a pretty detailed report. Now, not everything that we're going to cover tonight in this summit is on that website, and not everything on this website, on this webinar, is on the website. So they're complementary, not replacements for one another. In addition, you'll see the email address there. I will throw up both this email address, that toll-free number on your screen, and the website on your screen again towards the end of the presentation, right before we open up for Q&A. So don't worry if you don't have time to write it down. But that is the email. That is our service email address. If you think of a question later, after the summit's concluded, you don't get a chance to ask it during the Q&A session, no problem. You can drop us a line on that service@capitalisttimes.com address. Just real quickly, I'd like to go through and talk about the agenda for tonight. We're going to talk a little bit about, I believe we mentioned in our invitation to tonight's summit, a bubble on Wall Street that is, we believe, a major force driving market valuations, stock market valuations, which many of you know are already near record levels. We also believe this trend, and we'll explain it in much more depth here in just a minute, is already gradually eroding market liquidity, even in some very large companies. Walmart, for example, being one stock that's seen a big decline in liquidity. Now, what does that mean? It means that historically, when you go and you want to buy or sell a large cap company like Walmart, it's not a problem to go buy or sell it because there's plenty of buyers and sellers out there that you can be matched with in the marketplace. But nowadays, because a larger block of Walmart shares, for example, are being tied up by this trend I'm going to talk about, the stock's becoming much less liquid, and that is driving a notable increase in volatility. And this is something we've really seen in particular just over the past 18 months, 2 years or so. Also, overall in the market, we are seeing, and I'll show you in a little bit more depth here in a minute, a big explosion in volatility this year. After last year being kind of a do-nothing, almost a boring trading action of low volatility. I'm going to talk about a chart that actually, I'm going to show you how it does explain more than 70% of long-term stock market returns. And this is based on returns going back over the last 80 years. So, and I'll show you exactly what I mean by that and what this chart, what this indicator is telling us about the stock market today. We're going to talk a little bit about our three-step deep dive investing system for dealing with this new stock market environment and this bubble that we see on Wall Street. Near record valuations, rising volatility, and we're going to include some specific indicators that you can check out on your own. A lot of them are available for free on the internet, and some trends that we think you should be watching right now as we near the end of this bull market. You know, this bull market has now been going on for more than 9 years. It's the second longest bull market in history, and we are seeing some signs that we're getting late in the game. Not quite done yet. The uptrend isn't quite finished, but we are getting near the end of the trend. My colleague Roger Conrad is going to step in with his income investing guide some more information about the truth about the relationship between interest rates, Fed rate hikes, and income stocks. And he's also going to talk about 4 specific income opportunities he's recommending right now. We are going to have some specific stock recommendations to buy and some PANs, which means stocks to avoid. And of course, we will be opening up this webinar to a question and answer session. If you'd like to ask a question, you can either type it into the chat box that you see on your screen, or you can put it in the Q&A box on your screen. We won't answer them as we move through our prepared remarks, but we will answer them, as many of them as possible, at the end of our presentation today. One little word of warning about that. This webinar, we open up this webinar to a number of readers who are not currently members of our Energy and Income Advisor service or Conrad's Utility Investor service. Some of you are, most of you are, the majority are, but not all of you on tonight's webinar. It is open to non-subscribers as well, certain non-subscribers. As a result, if you have a specific question about, for example, an energy company or a trade that we're doing or an investment that we're recommending in Energy and Income Advisor, we may not be able to answer it because it wouldn't be fair to subscribers on tonight's call to answer questions about specific portfolio recommendations in the Energy and Income Advisor service. We're happy to talk about energy and answer a few questions along those lines. But we've had some complaints in the past when we basically get asked about every single stock in the Energy and Income Advisor portfolio, and a lot of our members have been upset, and I think rightfully so, that information is basically being shared in a public forum. But we will answer as many questions as possible. Final little housekeeping note, this webinar is being recorded, and we will provide a link to the recording following the event. Most likely, we'll have that link to the recording and a link to a PDF version of our slide deck, probably to you tomorrow morning or maybe even later on tonight. So that's the basic agenda, and we're looking forward to moving through these slides. As you can see, it's a pretty ambitious agenda. I'm going to try to move as quickly as possible so we can get through these slides and open up and spend as much time as possible on the Q&A. So my first slide here, and I wanted to talk about, some of you may be familiar with this metric, but Professor Robert Shiller is a professor at Yale University. And he invented and popularized a valuation measure for the S&P called the Cyclically Adjusted Price to Earnings Ratio, or CAPE ratio. Now, what exactly is this? And if you are interested in finding out more about that valuation metric, you can read his book, which is called Irrational Exuberance. It's available on Amazon.com. If you haven't checked it out, I'd encourage you to do so. It's a very interesting book. But the CAPE ratio, it's nothing really magical. A version of this has been done many times in the past. One of the first times I read about a metric like this was way back in 1992 in a piece of an academic paper written by Eugene Fama back then. So it's been around for a while, or a version of it's been around for a while. But basically what the CAPE ratio is this, okay? Obviously, there's a business cycle in the United States like every other economy in the world, right? So during an economic boom, earnings for the S&P 500 are going to expand. During a recession or a bad recession or depression, earnings are going to contract. So when in an economic boom, earnings could temporarily accelerate more to an above normal level. And it could make the market look kind of cheap, right? Because earnings are temporarily inflated by the economic boom underway. A classic example, think back to the real estate bubble, back in the last decade. A lot of stocks involved in the housing industry had sort of artificially high earnings because of that housing boom. It didn't represent a normal market environment for them or an average market environment, but kind of an inflated market environment. And the same is true on the downside, right? In a recession, earnings for a lot of companies are going to be depressed, and so they're going to look expensive, even though the earnings that you're using to calculate the price divided by earnings per share, the PE ratio, are depressed and are making it artificially expensive. So what Robert Shiller does is he averages the earnings for the S&P 500 companies over a 10-year time frame. And the reason 10 years is that it would include a full business cycle for the stock market. In other words, include a boom and a bust, if you will. So it gives you a better picture of the true earnings power of these companies. In addition, he adjusts earnings for inflation, right? So in some decades, I mean, you have the 70s, for example, we had a lot of inflation. So $1 in corporate earnings in 1972 was worth a heck of a lot more than $1 of earnings a decade later in 1982. So it's not fair to count them the same. So he also adjusts for inflation. So cyclically adjusted price to earnings ratio. It's just the price to earnings ratio adjusted for the overall business cycle. And we call it the CAPE ratio. And he actually provides data on the CAPE ratio going back to January 1881. Okay, so 137 years of data, which it's pretty impressive. And that's really one of the things that he talks about in the irrational exuberance, really just developing this huge data set that we could use to evaluate the efficacy of this valuation metric over that long period of time. And what I've done is I've shown you here, this is going to be the last 80 years of data on the CAPE ratio. And each of those blue dots on your screen represents a single monthly observation. So in other words, let's say that in February 1973, the cyclically adjusted price to earnings ratio was 25, okay? And the subsequent annualized return over the next 10 years, in other words, from February 1973 to February 1983 was 7.5%, then that blue dot would be plotted there. The vertical axis is the CAPE ratio. The horizontal axis is just the subsequent 10-year annualized returns for the S&P 500. And what you can see here is actually a pretty impressive fit, right? If you look at these blue dots, they do kind of line up on this chart. In other words, when you buy the stock market in a month where the CAPE ratio is very low, in other words, the S&P 500 looks very cheap, let's say the CAPE ratio is around 10, then you typically would see above normal annualized returns from the S&P 500 over the next decade. On this chart, it looks like you could expect to see upwards of 15% annualized returns. The average over this period is about 11%. In contrast, look to the upper left-hand side of the chart, and you'll see a bunch of blue dots grouped up there where the CAPE ratio was very high, and the subsequent annualized return for the S&P 500 was actually negative. So it's just really something that you probably all are at least familiar with or know at some level, right? If you buy stocks that are very, very expensive, when they're very, very expensive, your expectations for long-term returns from the market are much lower than if you buy a stock that's cheap. The red line that I've plotted there, it's just a trend line that I've plotted using a standard statistical technique. And you'll notice, it may be a little hard to see on your screen, but that number there, R squared, okay? That's just a statistical measure of how closely that red line fits the data on this chart. It ranges between 0, meaning no fit, and 1, 100%, indicating perfect fit. This is 70%, 70.32%. I got to tell you, it's not 100%, but that is about as high a number as you're ever going to see in long-term stock market returns from any indicator. In other words, the cyclically adjusted price to earnings ratio is often wrong in the short run. In other words, just because you buy stocks at an expensive price doesn't mean you're going to lose money over the next year or 2 years. But it does mean that the odds support subpar returns over the subsequent 10-year or long-term holding period. And what I really want to show you in this chart is where we are today. The current CAPE ratio on the S&P 500 is 33.3 times. In other words, the S&P 500 is trading at more than 33 times its cyclically adjusted price to earnings ratio. And I've circled that on the chart and put the arrow in there for you. Just looking at where the trend line goes, it suggests that an investor could expect an annualized return over the next 10 years of just 0.25%, a 1/4% a year. So that's less than 3% over a 10-year period total. Obviously, no one can live on those returns. You can get a much higher yield out of the 10-year US government bond right now. Why would you ever buy stocks with expectations for a 0.25% return? In other words, stocks are very, very, very expensive. Just how expensive are stocks with a CAPE ratio of over 33 times, 33.3 times? Well, according to the data provided by Professor Schiller, going all the way back to January 1881, so that's 1,650 months of data on the S&P 500 and the CAPE ratio, the market has only been more expensive than it is right now today for 38 months out of that entire 1,650-month period. That means that the stock market is more expensive today than it has been in 97.7% of all months over the last 137 years. Now, to me, that's an incredible and kind of shocking statistic to think about. The stock market's very expensive. As I said, over the past century or so, actually 90 years, if you bought the S&P 500 when it traded at around current valuations of 33 times cyclically adjusted price to earnings, your average return over a decade of holding stocks was a paltry 0.25% per year, which again, less than 3% over 10 years, not per year, just a 1/4% per year. Terrible returns when you consider that the average 10-year holding period over this time frame provided about an 11% return in the S&P 500. Now, as I said, an investor, the long-term returns from the stock market are very good. I'm sure you all are very aware of that. You've probably heard this statistic in one form or another before. But if you bought the S&P 500 on any random month that you just sort of threw a dart at a calendar, right, over the last 90 years and held for a decade, you had about a 94% chance of making a positive return. Maybe subpar, but a positive return. Kind of as close to a sure bet as you can get, a diversified portfolio of stocks over the long haul, right? But, right, investors who bought the S&P 500 when it was as expensive as it is right now or more expensive, so a CAPE of 33.3 or higher, would have lost money almost 2 out of 3 times. So buying stock, even though normally you have a 94% chance of making money in the market over a 10-year holding period, if you bought stocks historically near current valuations, you would have lost money almost 2/3 of the time. That's pretty pathetic odds. And let me talk about, and that's just one thing that we think is being driven by this bubble that I'm going to tell you about here in a minute, and we do think it's really a bubble. Here's another thing. This is actually an intraday or tick chart. So it just shows the intraday trading action for the Dow Jones Industrial Average, the venerable index invented back in the 19th century, right? On February 5th of this year, so February 5th, 2018. Now, some of you may remember that day. It was a nasty day in the market. Stock market opened lower, bounced up until around 11 o'clock or so, and then it kind of gave a steady drift lower throughout most of the rest of the morning, early afternoon. Now look where I circled here. At about 15:02, which is for those of us who prefer regular time, is 3:02 in the afternoon. So basically, about an hour before the market's 4 o'clock close, right? The Dow Jones Industrials Average was trading at 24,800. 24,800. It was already down about 3% on the day, so it was definitely not a good day. But as you can see there, from about 11 all the way up until around 3 o'clock, a little after 3 o'clock, the selling was pretty orderly in the stock market. It was kind of a gradual drift lower, but not a crash. But something kind of snapped at 3:02 that afternoon. And those of you who were maybe watching the market at this time remember, it was kind of scary. The Dow Industrials lost 857.12 points in 8 minutes. In 8 minutes, by 10 past 3, the Dow Industrials had plummeted below 24,000, a 3.5% loss in just 8 minutes. On the S&P 500, it was also about a 3.5% loss in a similar frame of time, and that represents $800 billion, 800 billion with a B dollars, vanished only from the S&P 500. All happened in just 8 minutes. Now here's what's even more insane. Look at this chart. By 3:30, it was already back up to where it was at 3 o'clock. So something snapped. The market kind of ceased to function for that 8 to 10 minute period after 3 o'clock back on February 5th. And I'm going to tell you in a little bit later why we think that was the case. In fact, let's go ahead and get right into it right now. This is a chart from Bloomberg showing money invested into assets under management at mutual funds and exchange traded funds, or ETFs, in the United States. In particular, I'm looking at equity mutual funds and ETFs. So these are mutual funds and exchange traded funds that invest in stocks, not in bonds or a mixture of stock and bonds. Since January 2012 up until this goes through May of this year, right? Investors poured $2 trillion, and that's trillion with the T this time, right? Dollars into passive index fund strategies. Over the same period in time, they withdrew $800 billion from active investing strategies. These are active mutual funds. So what is a passive mutual fund and what is an active mutual fund? A passive mutual fund, or ETF, simply tracks an index. Often the S&P 500, but there's certainly other indexes that are tracked by these passive funds. So they're not trying to pick stocks. They're not trying to pick sectors or individual stock names. These funds simply try to track an index, usually the S&P 500. An active fund has, as the name implies, an active manager. Somebody or a team, usually, of analysts and a head manager who are trying to figure out what stocks stand to outperform the broader market and what stocks might lag the broader market, and invest accordingly. So they're actively moving in and out of stocks, in and out of sectors. The passive fund manager's only trying to track. So we've seen a big move out of active funds and into passive funds. And frankly, there's some good reasons for that. One of them is that managing an active fund is kind of expensive. You have to pay all these people to research stocks. You have to pay a team to manage the portfolio. A lot of these funds, frankly, spend a lot of money on things like marketing. So the expenses can be kind of high. And honestly, the fund industry, the active fund industry, brought a lot of these outflows on themselves, this failure, if you will, on themselves. First of all, a lot of them underperform the broader market. But more importantly, I think, as many of a third of active funds, so-called active funds, are what we actually call closet index funds. In other words, they're not really making any major bets on sectors or individual stocks in the S&P 500, for example. They're only tweaking on the margin. You know, they're adding 1% to, consumer discretionary stocks, and they're taking 2% out of energy stocks, adding an extra 1% to technology. They're kind of tweaking the asset allocation of the S&P 500 slightly. Now, why do they do that? Well, they do that because they don't want to get fired. If you're a fund manager and you run an active fund and you underperform the S&P by a lot for a long period of time, you're probably going to get fired. You're probably going to get sacked, and then you're not going to have a job, and you're not going to get paid. So what you do is you try to come as close to the index as possible so that if you underperform, at least you won't underperform too much. And then you get to charge the investors in the active funds much higher fees than passive funds because you are, quote unquote, an active fund. People start to see through this garbage. The average mutual fund in the United States charged about a 1% expense ratio back in the year 2000. Now it's down to about 59 basis points, or 0.59%. The average passive mutual fund in the United States charges 9 basis point expense ratio, so 0.09%. The average active fund charges about a 79 or 80 basis point fee. So one reason that investors move from active funds to passive funds is quite simply the fees were high, and a lot of these funds were kind of closet indexing anyway. They were calling themselves active funds, but if you look, just scratch beneath the surface slightly, you can see that they were pretty much following the broader market, which frankly isn't much use. Why pay for that? However, the thing about trends on Wall Street is oftentimes something starts out as a great idea, and then it just goes too far. So let me, just a couple of examples. You might remember back in the late 80s, the concept of portfolio insurance. It was basically a way for fund managers to insulate their investors against market corrections and downturns and pullbacks. And it worked like a charm for a little while until too many people started doing it. Everybody was trying to do the same insurance strategy at the same time, and many people believe it was a major contributor to the 1987 crash. Or more recently, you remember collateralized mortgage obligations and mortgage-backed securities? Originally that was a great idea, right? If you could spread the risk of mortgage loans among a lot of different investors, the cost of taking out a mortgage was lower, more people could afford to buy a home, and then somebody decided that, house prices would go up indefinitely, and by the way, you could loan money to people who don't have a job. And the whole thing fell apart, and we ended up with the real estate crash. So, Wall Street has a long-standing tendency of taking a good idea like passive and index funds and just taking it too far. And I believe that this trend has been taken too far. In 2007, and this is across all funds in the United States, not just stock or equity funds, 85% of funds were actively managed. There was a total of $9.5 trillion invested in those funds. Only 6% of assets under management in the US were in index ETFs, so passively managed ETFs. Only 9% of assets were in index mutual funds or passive mutual funds. Today, 65% of assets in the United States are actively managed. The other 35% are passively managed. The share in ETFs, by the way, and it's a much larger pie of almost $20 trillion today, has almost tripled from 6% to 17%. And the share of index mutual funds has doubled to 18%. Now, everybody agrees on one thing, and that's that at some point, too much passive breaks everything down. And the reason is that if everyone just follows the index and invests in the same stocks without looking at the business fundamentals of the companies they're investing in, the market becomes inefficient. There was a report out a couple of years ago from AllianceBernstein where they compared a world of all passive investors. In other words, everybody just buys a passive index fund, saying it was worse than Marxism, right? Because in a capitalist system, good companies get more capital because investors buy the stock, which provides capital to the company. In a Marxist system or a socialist system, the government decides who gets money and who doesn't. In a passive index system, nobody decides, right? There's no overarching government power. There's no active fund manager looking at the business. Companies get assets simply because they have a market cap that makes them one of the largest companies in the S&P 500. For example, if you buy an S&P 500 index fund today, almost 3% of your capital will be invested in Amazon.com. A great company, but a company that's trading at 141 times 2018 earnings. Only 6% of your assets, $6 per $100 invested, would be invested in the 32 companies that comprise the S&P 500 Energy Index, even though oil prices have more than doubled over the past 2 years. Technology stocks would comprise more than 1/4 of your entire portfolio, the largest share in history, except for a few months in the late 1990s and early 2000s, and we all know exactly how that turned out with the tech collapse. The dividend yield of your portfolio would only be about 1.9%. That's more than 100 basis points or 1% less than the yield on a 10-year US government bond. You would be investing more in an index fund in Netflix, trading at 146 times forward earnings than you would be in McDonald's, gold miner Newmont Mining, semiconductor equipment maker KLA Tencor, regional bank Comerica, and Tiffany's combined. So you can see is that really how you want to invest your money in those really expensive stocks? Simply because they're the largest stocks in the index, they're going to receive most of the capital invested into these passive funds. You want to know why the market looks so expensive? It's because a lot of this money has been pouring into these funds, raising all boats, but raising the boats, the biggest boats, right? The ones that have the highest weight in the index, even higher, faster than any other. So companies like Amazon, which are already very expensive, keep getting money regardless of how expensive they are, because nobody is thinking they're buying Amazon. They're just buying the overall S&P 500. I'm not going to spend too much time on this chart, but what this is it's the blue part of the chart is the European Central Bank, the gray part is the Bank of Japan, and the orange part is the Fed. This represents the total amount that these central banks, the three large developed world central banks in the world, right, have invested in buying government bonds, and in the case of the Bank of Japan, also stocks, right, since 2004. So back in 2004, the total size of all three of these central bank balance sheets was up around $3.8 trillion combined. Today, it's well over $14 trillion that these central banks have poured into the global bond markets. Now, a lot of people thought that this quantitative easing campaign would show up in faster inflation, and it has to a degree, but I can tell you where it's definitely shown up. It may not have shown up so much in goods price inflation, in other words, the price of commodities or the price of apparel or telephone service, but I tell you what it's shown up in, and that's asset prices, stock prices in particular. A lot of this money that the central banks have been, liquidity that central banks have been pumping into the system, $14.6 trillion over the last, over this period of time covered by this chart, has ended up in the stock market. And as I showed you, a lot of that money has been flowing into these index fund products, indirectly flowing into these index fund products, and that has inflated the valuations for the stocks in the index, and made the market overall more expensive than it's been in almost 98% of the time over the past 137 years. A couple more implications and sort of statistics, if you will, about the market. Vanguard, which is the largest index fund company out there, the largest passive index fund company out there. And again, I have nothing against Vanguard. I think the founder, John Bogle, is a brilliant man who filled a niche in the market. Nothing wrong with index funds. It's just that it's going too far today. Today, Vanguard alone controls 7% of the market capitalization of the S&P 500. One company, one fund management company, controls 7% of our stock market. That's more than doubled since 2010 alone. Marko Kolonovich, who is JP Morgan's head of quantitative trading, says that fundamental equity investing, in other words, people buying or shorting individual stocks based on fundamental or technical criteria, accounts for just 10% of the daily trading volume on the New York Stock Exchange and NASDAQ. The rest is primarily passive and quantitative smart beta types of strategies. Some stocks, including Leggett & Platt, which is a S&P 500 company, it's a furniture manufacturer, Helmerich & Payne, which is an onshore land driller in the energy industry, Ryder Systems is a trucking logistics company. I think you probably know what Walmart is. These companies, some of the biggest in the country, have more than 20% of their outstanding float tied up in passive funds, and we've been seeing volatility for these stocks drift higher. In short, the global liquidity tsunami I showed you on this prior slide, all this money being pumped into the global financial system in the form of quantitative easing by the world's three largest central banks, has a lot of it's found its way into passive investments. It's leaked into asset prices. If you don't believe me, read the Fed minutes over the last couple of years. The Federal Reserve has been talking about this risk that their actions to stimulate growth, their actions to keep interest rates down has resulted in some asset price inflation. It's lifting all boats in the market regardless of fundamentals. No one's paying attention to fundamentals because passive investing has become such a big part of the market. By the way, I showed you on that prior slide that passive investing accounts for about 35% of all assets under management in the mutual fund industry. That includes bond funds. For stock funds, equity funds, the figure is actually 43% of all assets under management in the stock equity mutual fund industry is in passively managed index mutual funds and ETFs. By 2020, it's thought it will be over 50% of the stock market. One more thing to keep in mind, as I said, this is already the second longest bull market in history. Eventually, it's going to end. Business cycles always come to an end. Anybody that tells you otherwise is crazy. You should run the other way. What's going to happen when this bull market finally does come to an end? Instead of all this liquidity, you already see that some central banks, the Fed has already ended quantitative easing and is now kind of draining liquidity out of the system. European Central Bank is going to end its quantitative easing program at the end of the year and begin to gradually drain money from the system. What happens when this liquidity tsunami dries up? What happens when interest rates go up? What happens when the market starts going down and instead of people taking the money that they earn and putting a portion of their savings into index funds, they're actually redeeming those funds to cover their expenses as the economy sours. What's going to happen? I can tell you what's going to happen. It's going to be a mirror image of what you've seen over the last 9 years. The liquidity floated all boats over the last 9 years, particularly those big boats, the largest components of the bull market, of the stock market, that had this nice tailwind of all that money being pumped into them from passive funds. When it starts moving the other way, they're going to have the same headwind, but it's going to be a headwind instead of a tailwind this time around. So with that, I want to turn the floor over to Roger. We're going to kind of pass the virtual mic back and forth. As I said, I'm going to turn it over to Roger, talk a little bit about the implications he sees on the income side from this same basic trend.
Well, thanks, Elliot. And again, thanks everybody for tuning in. We talk about growth. We also talk about income in deep dive investing. So I want to focus on high yielding types of investments and what that means in the context of everything Elliot was just talking about regarding the rise of ETFs, kind of the dominance of exchange traded funds in daily trading, because it hasn't just affected the big stocks that everybody's heard of or stuff that's in the S&P. It's also affected stocks that we might own for just income. We might not think of them as being volatile, but suddenly, because of the rise of ETFs, they are considerably more volatile. So, again, this slide makes a few general points. ETFs are increasingly held in strategies controlling trillions of dollars. That's not a misprint either, and governed by algorithms. And algorithms are basically programs created by humans, but that are capable of trading stocks at literally many, many times faster than ordinary humans can. So one of the things that's kind of interesting about all these algorithms is just how similar many of them are. And particularly when it comes to dividend-paying stocks, and I'll give you an example of that in just a minute, of how trading even in stocks that we're not used to seeing being volatile has become considerably more volatile. Algorithmic trading is capable of moving around billions of dollars in seconds. That's another major innovation here with this. The most popular algorithms appear to assume a lockstep relationship between benchmark interest rates and dividend-paying stocks. So the most popular, that's really I think the biggest impact that we've seen of the age of ETFs on dividend-paying stocks is the most popular algorithms are basically assume a lockstep relationship. I'm going to show you that is absolutely not a predictable relationship there, and particularly when it comes to annual returns. But let's take a look at the next slide here. This is, again, sort of an example of what's happened with the rise of ETFs. This is Vanguard. Elliot spoke of them earlier, and they're one of the larger players. They're, more importantly, for purposes of income investing discussion, they're a major player in a lot of the funds that hold income stocks and so forth. So you can see it's been pretty much a geometric increases here in terms of assets under management, just a real tremendous growth. And, you know, again, hats off to Vanguard very effectively marketing these tools, but it has led to incredible, again, like I said, incredible concentration of assets in the hands of players that are doing pretty much the same things. Always kind of a dangerous thing for the market. Take a look at the next slide here. And this is another group that has quite a few assets and also income stocks, heavily affecting income stocks now. And this is BLACKROCK. So BLACKROCK, similarly sized, and again, very large, passively held or passive strategies, using algorithms, using exchange traded funds that hold very large stocks. So this has really become a major element of trading. And again, even for income stocks where ordinary investors buy and hold, or say an actively managed fund would have a much longer time horizon than an ETF or a passively managed fund. Take a look at the next slide, and we'll just continuing with this with the argument. You know, I mentioned an algorithm that basically, you know, very similar. I think one that's followed pretty consistently. If you look at dividend-paying stocks, and this one is actually from BlackRock, but you can see this is a slide that they put together, and their point here is that defensive stocks go down when the 10-year Treasury yield goes up. They're using they're using data from 2000 to 2018, and they're using monthly returns and they basically compare performance of all these various stock groups in months where the 10-year Treasury note yield has ended that month on higher ground than when it began it. So, you know, a pretty compelling look of evidence here. But take a look at the next slide. You know, and you can see it's almost the opposite thing. Now, if you're investing month to month, if that's your strategy, that then obviously what was on that previous slide should carry a lot of weight. But if you're investing in any kind of longer term time horizon, and I'm just talking about a year on an annual basis, you can see from this slide that so-called relationship between changes in the 10-year Treasury note yield and dividend-paying stocks really breaks down. Now, the TNX is the far right-hand column of this table, and the TNX is the 10-year Treasury note yield, and specifically the change in the 10-year Treasury note yield over that time frame. Now, 2018, we're only up through the current date, so we're less than halfway through the year. But if you go down these other years, you can see that, there really is no lockstep relationship between what happened in the TNX and all these various these dividend-paying stock groups. And reading over from the left, you have the S&P Telecom Index, you have the Dow Jones Utility Average, you have the Bloomberg REIT Index, you have the Alerian MLP Index, finally you have the S&P 500. Look down the middle of the table there to 2013. You see positive numbers for pretty much all these stock groups. Look over to that far right-hand column. That was a big, big increase in the 10-year Treasury note yield. So in that year, all these stock groups did pretty well. You made money, and that was in a year where the Treasury note yield rose by more than 70%. Now, not 70 percentage points, but the percentage change between where it began the year and where it ended the year, over 70%. So a big increase in interest rates that year. Also, look down at 2009, you can see another big increase in interest rates that year. Also a very, very positive year for these groups. 2008, on the other hand, a very negative year for all these groups, but a year where interest rates, these benchmark interest rates, basically fell in half. So, you know, you can draw whatever conclusions you want over the table here, but you can see that what affected the returns was not interest rates. You know, take a year like 2015, the Alerian MLP index down, and that includes dividends down by nearly a third. That a year where interest rates were basically flat. What happened that year? Well, you know, energy prices and in particular MLP prices came down pretty heavily. So, you know, again, no lockstep relationship in any of these indexes, and when you're looking at a year long. So, you know, any kind of investor, if you have any kind of time horizon, you're interested in income, you're going to hold your stocks for a year. Otherwise, you know, you run into a lot of problems with, you know, first of all, you don't collect a lot of dividends, and that sort of defeats the purpose of an income strategy. But you're also missing out on the capital gains that come from a rising dividend. You're paying a lot in commissions and fees and so on. So suffice to say that most people, when they buy dividend-paying stocks, aren't thinking in terms of a month. The returns, you're thinking about annual returns. And if you're thinking about annual returns, then that algorithm that I showed you earlier in the presentation, where you can see how BlackRock does it, you know, they're looking at the monthly gains and losses in the 10-year. It's really not a viable strategy for you. So again, this is kind of one of those, kind of a dissonant event that's happened here with the rise of ETFs. Let's take a look at the next slide. And this is what happened to the Dow Jones Utility Average versus the S&P during the last bear market. So I put this slide up here to show you what really is the driver for utilities, just as it is for the S&P, as well as to show you that in a typical bear market, the utilities, or at least in this bear market, the utilities were the last to drop. That was the last group that people really sold, and you can see it sold off. Well, what is this graph showing you that begins at the end of 2006 and ends at the end of the bear market there? Well, first off, you know, I guess utilities didn't fall as far as the S&P, but they did follow pretty much in lockstep. And what the catalyst for that bear market was the economy. So this the point here is that, you know, this group that's so-called interest rate sensitive is actually more economic sensitive than anything else. Let's take a look at the next slide here. And this is the last 12 months of the DJUA versus the S&P, and you can see how the
Roger, I think we might have lost you there.
Oh, sorry about that. I just cut out there for a minute. So this graph shows you what's happened the last 12 months. And one of the stories that's happened here is that utilities have greatly underperformed over the last 6 months or so. And, you know, if you go back to the previous graph, you can tell that things actually, you know, they were actually the last group to drop. So, you know, this is another kind of anomaly that I think is caused to a large extent by the rise of ETFs, also by the fact that you know, algorithms are in play here, and ETFs to a very large extent. This is definitely a much different picture than we saw that early on. So I'm going to show you actually a way or how we are looking to take advantage of that, because kind of the end result of this happening is that, or, you know, overall result is that we already have things that have happened. Things have already happened faster. We've already have something of or much lower, or certainly much deflated valuations in the utility group, much deflated valuations really in pretty much every dividend paying stock group now. that's a positive. That's actually a positive. We're seeing stocks get down to levels where we might expect them to get down to when things sell off. So again, a sort of different behavior there, but again, you can see, I think, at least a piece of this persistent selling is because we have algorithms kind of making this happen with these. So something that's kind of, again, if you followed utilities as long as I have, which goes back to the mid 1980s, you've seen a lot of ups, a lot of changes, a lot of ups and downs in the group. Definitely this kind of persistent rationale that you sell them when interest rates are rising. But again, looking at that graph, you look at the 1-year trends, it's a much different story. But again, algorithms becoming more important here. So I'm going to move to the next slide about that. Okay, moving to the next slide. What does this mean? Well, greater algorithms and income investing, first of all, means greater volume in fewer hands, which has always kind of been a dangerous thing in the market. But as we've seen, it's already created greater volatility, and particularly when there's an obvious catalyst. In this case, this truism that you want to sell dividend-paying stocks when interest rates are rising, and that they're not stocks, they're basically and they're not economically sensitive, but they're interest rate sensitive. And again, I think if you go back to that other slide that I showed you at your leisure, you can see that at least in terms of annual returns, which I think are more relevant to us, that's not true. But and that doesn't hold. And again, that's a reason for being bullish on a lot of these stocks now that they're at lower valuations. Definitely, another consequence of increased algorithmic investing and use of ETFs is that leverage becomes all the more important. So if for example, if you're caught out and you're highly margined on a particular stock, that can mean some pretty big losses for you. Whereas in the past, perhaps that was a way to increase the income off securities. Not too many individuals use these types of strategies, but they're definitely heavily used in funds. So it actually makes fund returns more volatile as well. So that's the danger. The opportunity, of course, is if they're managed intelligently, and particularly the use of options is quite a good thing if used well in this type of environment, because relatively small moves, say if you would happen to sell or write some put options on a big dividend paying stock, and which represents a bet really against if people buying those puts from you represents a bet against the stock. If that stock just stays level, you collect that options income. So you can actually increase your income by quite a large amount. Now, this is a strategy that a lot of people tout, of course, and there's tremendous danger because let's say that stock does continue to drop, then you wind out, that put option gains in value, and you ultimately have to cover it, or you have to buy the stock at the equivalent of a much higher price than where it might end up. So, there's danger of leverage, but again, the more leverage there's out there, the more opportunities. This also applies to individual companies and individual company selection, which I'll talk about in a minute. A company that has more debt and has to refinance debt, or depends on for example, outside capital, those become actually more dangerous in a more volatile environment, because if they happen to not be able to raise capital on reasonable terms because of high levels of leverage, they might wind up doing things that would be destructive to wealth, such as having to sell an asset at some point. So again, danger and opportunity. And this is accentuated by the fact that you do have these algorithms trading. ETFs don't differentiate. Again, this is a point Elliott made. I mean, they're strong companies sell off with the weak. I think that the benefit that we've seen for income stocks is that some high quality has gotten pretty cheap, even with the rest of the market continuing to rise, even in what's technically called a bull market. Still, you're seeing high quality stocks get down to levels where they actually do have some pretty good defensive qualities. And then, many stocks are sells. In fact, that's probably in all the stocks that we cover as a company, there are probably about as many sell recommendations that we have as we usually have. But there are, again, also buys even this late in the bull market. So, let's move to the next slide. I mentioned individual stock selection. I think this is more important than ever. I consider this to be kind of an edge of our organization because we do focus pretty heavily on individual companies. And deep dive investing, we cover pretty much the waterfront. So we have a lot of different types of sectors to show you, which I'll be looking at in just a moment. But when we look at a sector that we like, we see some values. We want to, and we start looking at individual companies. We first want to look at how sustainable is the dividend and the interest. That's more than just looking at a payout ratio or any single factor. It's looking at a range of different factors, including things like how much debt is due in the next couple of years, including things like again, also, how well dividends are covered by earnings, but we want to know what's behind those earnings and, how sustainable they are. So that's very important. It's also important for stocks. It's also important for bonds. You never want to buy a bond of a company that you wouldn't want to own the stock of. And that's just basically, it doesn't mean a stock might be at a high price where you might not want to buy it. But you don't want to buy bonds of companies that you don't believe in the prospects, even bonds that are sub-investment grade. The secret to those is buying bonds that are where the companies are really on the come, where they're getting stronger. So the credit quality is getting stronger, and you're able to benefit from actually a tightening of the credit spread. And I'll talk about that a little bit more in a moment. But that's, again, a question. How sustainable are those dividends and interest? Very, very important. Really the first thing that we look at. We also want to know if is this a growing company? There are examples, and particularly now, of companies that don't seem to have a lot of growth prospects, but have pretty big yields that are very sustainable, where we might want to stay with them over time. There are some examples of that, but generally, what we're going to look for in an income stock or dividend paying stock is some growth. We don't want just utilities, for example. We want utilities plus. We want a company that has some upside catalyst, that's growing its dividend, and so on. That's really the secret to being plugged into the economy and being able to buck a rising interest rate trend, for example. That's really the difference between dividend paying stocks and which are more economically sensitive, and bonds, which particularly high quality bonds, which are very which are exposed to changes in interest rates. So again, growth, very important. How exposed are revenues to cyclical pressures? Cyclical pressures, I mean things like the level of economic growth, that can affect revenues. We saw particularly master limited partnerships take big hits from being, and even pipeline companies, from exposure to commodity prices a lot of people didn't reckon with, which basically even a pipeline company, its dividend depends on the creditworthiness of its customers. And in many cases, these are producers that are shipping energy through their, or marketers shipping energy through their pipelines. Well, if those companies aren't producing a lot, if prices have come down, as we saw in 2014, particularly 2015, that business does dry up. So even if companies have contracts, when those contracts come off, those become less valuable, and so on. So again, those are things that we look at, and we want to make sure that that the dividends we have, that the growth we have, are not so exposed. Particularly at this point in the cycle, because if we do have a stock market correction, there will be some wealth effect, and we don't want to have companies that are having trouble right now. Just think about the troubles they might have when things get a little worse. Can the underlying business continue to grow if access to capital markets becomes more difficult? That's another, I mentioned that just a minute ago in terms of how sustainable things are. We want that business to be able to grow on its own, or at least be stable on its own. Right now, we're looking very unfavorably toward companies that need really rely on outside capital. Now, that doesn't apply, incidentally, to companies that are still able to raise it. But it does apply to companies that are going to have to raise it over the next 12 to 18 months. Could be a very dangerous period. In fact, some companies are already having troubles. Also, then finally, what are the regulatory risks? This basically applies mostly to utilities and regulators and so forth, which has been actually a good thing for utilities, but also the federal government. How exposed are companies, say, to various trade regulations, tariffs, and so forth? That's become more of a concern for us. But we kind of want companies that are more insulated. On the utility side, we want companies that are working well with their local regulators. So differentiation, and I'm going to talk about a number of sectors, and I'm going to talk about how we differentiate in those sectors and how some of the better plays out there in those sectors. So let's move to the next slide, I guess. And Elliot is going to talk a little bit more about the passive investing and some larger issues.
Yeah, thanks, Roger. Well, of course, this slide, those are lemmings sort of going off the cliff. But what I'm trying to show here is that historically, and it's true in all financial markets, certainly you can follow trends. You can make money following trends that are popular or strategies that are becoming more popular. But the most dangerous thing you can do on Wall Street is when everyone is doing the same thing and you get involved in that same exact trend. In other words, you're participating in a crowded trade, something that everyone is doing. So many instances in history. I mentioned portfolio insurance and the '87 crash. I mentioned mortgage-backed securities and the real estate crash. There was an incident back in the late 90s where a hedge fund, LTCM, long-term capital management, failed because they put so much money behind their strategies that they became the market and ended up going bankrupt and losing billions of dollars and having to be bailed out by the Fed. When everybody puts all their money behind one strategy or one trend, it is usually time to run the other way. The other sort of counterparty to that is, I like to say that fewer eyeballs equals higher returns, right? So if you're investing in a company that has, 50 analysts, like a large bank like JP Morgan Chase, right? It has 50, 60 analysts on Wall Street that rip apart every press release that company sends out, listen to every earnings conference call, talk to management team on a regular ongoing basis, have earnings models that they update. It's very hard for you to gain an edge in a stock like that because it is so widely followed. Of course, people can be wrong, but there are a lot of people looking at it. There are a lot of watchers. On the other side of the coin, there are a whole lot of companies out there where there aren't as many watchers. And this is where the inefficiencies lie. If everyone's doing the same thing and looking in one place, you're probably going to find more opportunities where people aren't looking. In smaller companies, in making large active bets, in other words, making real bets, real investments in a sector that you think can do better because of where we are in the cycle, for example. And I'm going to talk about the simple 3-step process that we use that kind of governs what we do. But I think this is probably even the most important underlying concept. You don't want to follow the crowd in this case. If everyone is buying passive index funds, therefore everyone is buying the same stocks, there's going to be trouble when that uptrend comes to an end and the bottom drops out, just like you see here on this little cartoon. If we move into sort of the nitty-gritty of our strategy, number one, and I also explained this on the website that I mentioned earlier on, and I'll throw it up again here in the end, but step number one for us is mine the cycle, the economic and market cycle. This is a very basic cycle diagram. It's actually kind of a, I guess, sort of a stripped down or simplified version of the one that I use. But it illustrates the cycle that the market and economy goes through over time, right? So if we start in the lower left-hand corner, the green segment there, recovery. For example, in the most recent economic cycle, that probably would have been 2009 up to maybe early 2011. The U.S. economy was in a vicious Great Recession from 2007 to 2009. But in the spring and summer of 2009, we began to see green shoots for the economy. What works when the economy comes out of recession? Well, small cap stocks tend to outperform large cap stocks, not always, but usually. Companies that are more volatile than the market tend to see the biggest gains. Riskier stocks tend to see the fastest gains. Interestingly, value stocks, so cheap stocks, tend to outperform growth stocks. That's because when the economy is growing, most value stocks are kind of cyclical companies. They're economically sensitive companies. You know, Roger was talking about that on the last slide. They tend to outperform when the economy is growing and picking up. And when it's coming out of recession, it's growing particularly quickly. Eventually, we get to that blue segment. That's kind of the mid-cycle of the bull market. We've been in that part of the cycle really since 2011 or 2012 or so, up until I think around the present time, where we're kind of, I believe, straddling that blue and red segment on the chart there. In the blue segment, you're seeing solid or rising economic growth. You're seeing pretty low market volatility. That was certainly the case last year. What works at this stage of the cycle? Beta, riskier stocks. However, stocks do tend to move more as a herd in that mid-cycle environment. And that's why index fund type investing and passive fund investing have really taken off so much this cycle, I believe. It's partly because it's been tough to beat them. If the whole market's going up in a highly correlated fashion, in other words, most stocks are kind of like zombies, just sort of stumbling along in one direction, then you can do pretty well by buying the market. The problem, of course, is that as we enter that red segment of the chart, the late cycle, volatility almost always picks up. I call it the volatility smile. Stock market volatility is usually highest in the beginning of an economic recovery and at the end of the bull market. In the middle, it's kind of low. So you have this smile pattern in volatility. Also in the red cycle of the chart there, inflation picks up. Commodity, gold companies tend to do very well. That's an area we're very interested in. Growth stocks tend to outperform value as the economy starts to slow down in the later part of the cycle. The yield curve flattens. One group that I think is really important to focus on are quality stocks. These are stocks that have pretty steady earnings and profitability or return on equity over time. That's a group that we've been focusing a lot on deep dive, and those stocks have done well for us. And then finally you get, and I know I'm going through this very quickly, but again, there's more on this on that website I put up there, and I don't want to keep you here all night. But you get to that gold segment. That's where the U.S. economy is entering recession, and you have a bear market. How do you operate in that? The worst thing you can do is be invested in index funds because they're going to go down with the market. Bonds can do well. Certain bonds can do well in that environment. Quality stocks tend to do well. Large caps beat small caps. But the most important word on that chart, hedge. You need to be thinking about when the risk of the market topping out, the risk of the bull market ending is becoming more imminent, you need to start hedging yourself against downside risk in the stock market. That alone will probably do more to improve your long-term market returns and actually let you sleep at night in a bear market, because it can be pretty scary, than anything else you can do. So that's a very, very basic look at the economic cycle. And as you can see, it's not always 100% accurate, of course, but it does give you, at each stage of the cycle, certain stocks, certain strategies, certain characteristics tend to outperform. So this is kind of a basic roadmap that can help you understand where to look to produce solid returns to beat the market, right? So the first stage in the process is mine the cycle and try to assess where we are in the cycle. In deep dive investing, we launched, it was last December, a strategy, a system, if you will, which we call the bear market checklist. Now, a checklist, I mean, look, if you're a pilot, you have a checklist to make sure that you get everything on the plane sorted out before you take off. I used to sail, same thing on a boat. You have a checklist, things you get ready, set up before you go out on the water, right? It just makes sense because it keeps your mind organized. So we created this 10-point bear market checklist. These are 10 indicators, 10 events that tend to precede an economic downturn and a stock market bear market, okay? And there are 10 different things there. Don't worry, I'm not going to go through all of them here. There is a presentation we have up on a Deep Dive Investing website. I'm going to give you an opportunity to do a risk-free trial of that if you'd like. And you can check it out in detail if you want. But here are two of the more powerful indicators out there. This first one is a Conference Board's U.S. leading economic index. It's basically an economic indicator. It stood the test of time. I've looked at this indicator going back to the 50s. And it summarizes the performance of 10 key economic indicators, covering everything from the labor market to manufacturing activity, credit market conditions, interest rates, you name it. There are all sorts of different indicators in there. You can find this, by the way, on the web, conferenceboard.org, O-R-G. You can get it for free, this data. Not a nice chart like this. I pulled this off the Bloomberg, but you can get the actual data. I look at it in a number of different ways, but here's just a great little rule of thumb that you can use that can protect you from when the market gets dangerous. And that's to look at the month-over-month reading in Leading Economic Index. It's released every month around the 19th or 20th of the month. Look at the month-over-month readings. And what I do, it's so dead simple. I actually just look at the last 6 months of these LEI month-over-month readings. And when 3 or more of those readings are negative, you have elevated risk of recession within the next 12 months. So you can see here, back in 2006, it signaled elevated risk of recession. And then by late 2007, December 2007, the US economy was in recession, and we started the worst bear market for the S&P 500 in many decades. Right now, however, as you can see, we see none of that. LEI is strongly positive, has been positive almost every month for the past 2 years, literally. In fact, I'm seeing some signs of acceleration. The US economy right now is in pretty good shape. And what that means is that we're probably not yet at the end of this bull market. It's not yet time to jump out of the market. In fact, let me just give you a couple of little words of warning about selling too soon, which can be even more dangerous than selling a little bit too late. In the final 12 months of all bull markets since 1937, the US S&P 500 has returned an average of about 25%, including dividends. In the final 24 months, 2 years, the S&P 500 has returned an average of 58%. So if you miss the last 2 years of a bull market, on average, you're missing out on more than 40% of the entire cycle's gains. You can't afford to do that. Don't sell too early. Here's something even scarier. I haven't actually examined this data myself. I got this out of a report by, I believe it was Bank of America Merrill Lynch. But check this out. Since 1930, if you just bought the S&P 500 in 1930, which was the beginning of the Great Depression, and held until, I believe they ran this data through April, your return from owning stocks was about 10,055%. So huge, huge gains. Obviously, you would have had to hold for a very long period of time, but huge, huge gains. However, if you tried to time the market too much, right, and you missed just the 10 best days in each decade over that time period, your total return from 1930 until earlier this spring would only be 31% total, not 10,000%, 31%. So, and that's only missing the 10 best days out of an entire decade, which includes what? Well over 2,000 trading days in a decade where the market's actually open. You miss the best 10, you give up virtually almost all of your gains. So it pays to not be too early getting out of the stock market. Some of those best days, best trading days happen at the end. So it's too early to get out now. We are preparing a hedging plan because we are seeing signs such as rising inflation that suggest that we're getting close to that red section, that top right section of that cycle chart I showed you, where you really need to start thinking about how to hedge your downside risk when we do get a bear market. And we do think it could be a doozy. As I showed you, look, I mean, stock market valuations in the 98th percentile almost. Stock market could go down 50% and still be just average, sort of at an average long-term valuation. That's ugly. You don't want to get caught in that, but don't sell too early. Here's another one that we like to use, and this is stock market breadth. This is a cumulative advanced decline line for the New York Stock Exchange. Simply put, when it's rising, most stocks are going up. When it's falling, most stocks are going down. Historically, this indicator, in the final stages of a bull market, the advanced decline line tops out before the broader market. That happened back in 2007, where the advanced decline line, which I just circled that part of the cycle there for you, the advanced decline line topped out in June. The stock market topped out in October. Look at what's happening right now, though. The advanced decline line reaching new highs because small cap stocks are outperforming large cap stocks. Very unusual if that were to happen right before the top. But again, I do think we're getting close. Those are just two of my 10-point bear market checklist indicators. And I can tell you that about 5 of them out of 10 are signaling potential trouble. Historically, you shouldn't get too worried about the market until 8 or 9 of them are signaling trouble ahead. So we think there's a little more upside here, but it's time to start preparing. So what do you buy? I talked a lot about passive funds. I talked a lot about the smart beta funds and quantitative funds. Roger did as well. For some reason, this slide is not showing up on my screen right now. But what I wanted to show you is that the return, back in March of 2017, so about 15 months ago, we recommended a series of financial stocks in deep dive investing. Since that time, the average deep dive financial stock on our recommended list, and I can tell you it's up 27.87%. The S&P 500 over an equivalent holding period is up 8.3%. And the ETF that tracks the financials is up 14%. So we almost doubled the performance of the ETF that tracks the banks, and we basically more than tripled the performance of the S&P 500. In deep dive investing, we focus on doing what most people are not doing. Remember I told you returns are sort of negatively correlated to eyeballs. Fewer eyeballs equals higher returns. More eyeballs equals lower returns. Because most people are trading ETFs now, they're not looking at the individual stocks anywhere as much as they used to be just a few years ago. Only 10% of trading volumes in the US markets are directed at traditional fundamental analysis of stocks rather than the broader market or quantitative systems. And we've proven that through superior returns in a lot of the different themes that we recommend in deep dive investing. Let me give you an example. In the banking industry, which we do have the working chart up on our website there, showing the 27.87% return since March of 2017. One of our top picks is a bank called FCB Financial. It's trading around $60 a share right now. It's up a lot since when we got in. We still think it's worth buying under 60. It's a small Florida-based bank, about $3 billion, a little under $3 billion market cap. Only a handful of analysts cover the stock. It's not in the S&P 500. It's not a major component of the regional banking ETF or the financials ETF. It's not in the financials ETF. Very few people look at it, but it has a lot of things going for it. One of them is that they have a lot of commercial and industrial loans. You've probably heard this a lot on financial television, for example. Pundits will tell you, rising interest rates benefits banks, benefits financials. Sometimes true, but not always true, right? In the case of FCB Financial, it does benefit them because a lot of their loans are commercial and industrial loans. Commercial and industrial loans made by banks carry floating interest rates, which means they reprice automatically when the Fed hikes rates, basically. Other banks, like New York Community Bank Corp, have a lot of fixed rate loans where interest rates are locked in the case of New York Community Bank Corp, for 5 to 7 years. And if you buy the ETF that tracks the regional banks, you buy banks that have floating rate interest rate exposure that benefit from rising rates, and you're buying banks that actually are harmed by rising interest rates, like New York Community Bank Corp. How did we outperform the stock market so much, the regional banks so much since last March? We actually analyzed, I'm not saying it's easy, I'm not saying it's not time consuming. We went through 58 different banks, looked at their actual loan book, looked at their exposure, good old-fashioned analysis, and identified the banks that had more exposure to rising interest rates and recommended avoiding the banks who had less exposure to rising interest rates or were actually harmed by rising interest rates. Bank Corp. By the way, New York Community Bank Corp, a bank I'm asked about all the time because it has a high dividend yield. I think that dividend yield could be at risk. And at any rate, until the Fed stops hiking rates, NYCB is in trouble. So that's the second step of the process for us. Once we identify the sectors and groups that we think are going to perform well at this stage of the cycle, we then do, as our service suggests, a deep dive into the industry to identify the fundamentals that actually drive performance in these stocks. Not buying the whole group, but identifying the key fundamentals and which stocks are going to benefit most from them. I'm going to now turn the floor back over to Roger to talk about a couple of, or actually 4 of the opportunity areas he sees in income stocks going forward.
Thanks, Elliot. So, as Elliot explained there, we have a process, and when we get through the decided sectors and so forth, then we look at individual companies, and that's of course what I was talking about with particularly with regard to income stocks in the first segment that I gave. But I want to talk about some individual sectors now and why I think they're interesting. I'm also going to give you a pick as well that we actually have in our focus list. Our focus list in Deep Dive Investing is our top recommendations at any time. We also have what's called an idea vault, which looks at pretty much all the stocks that we have mentioned in previous presentations, and those are given with buy, hold, and sell advice as well as the focus list. So we don't ever abandon you on any recommendation. That's the idea of the idea vault, and the focus list is our top recommendations. So one sector in the income investing space that has particularly attracted my attention here are the yieldcos, and yieldcos are kind of MLP or master limited partnership clones, perhaps, though they are organized as corporations, and you get a 1099 when you for the dividend interest that you receive over a year. But the idea is pretty much the same, where you have companies that, in the case of yieldcos, primarily wind and solar contracted assets, and contracted is really the operative word there. In many cases, contracts lasting 20 years or longer, and with accompanying debt on those facilities that amortizes or that amortizes or is paid off over the life of those contracts, or in many cases, well before those contracts expire. So what you have is a very stable cash-generating vehicle, and there are parent companies. All of them actually at this point are run by stronger entities than they were 6 to 9 months ago. That's been a really big change that we have talked about in deep dive investing on the sector. And sponsors are really important for the same reason they're important for master limited partnerships, because they determine what sort of financial support the yieldcos get. But yieldcos with a strong financial sponsor, you can find them yielding anywhere from 5 to even up towards 9%, and growing those distributions up to 15, 25, even in some cases 20% a year. I think most of them are probably going to settle down into a range of 5 to 8% a year, because that's an easier pace to absorb new assets, and particularly in an environment where dividend-paying stocks don't command the high valuations they did just recently. But if you look at this graph, this is an index of the yieldcos. Also includes some UK-based yieldcos. But as you can see, we kind of hit a low point back in the early part of 2016, which actually corresponded with the low point in master limited partnerships, even though most of these companies really are not that exposed to energy prices, if at all. But they did bottom out around that time, and since then they've been ratcheting higher. If you look at that last low point, which was latter part of 2016 coming into 2017, that was when we started seeing sponsors changing hands, and particularly some of the ones like Terraform Power, which had SunEdison as its parent. SunEdison went bankrupt, and they wound up, though, selling their interest to Brookfield, to a unit of Brookfield Asset Management. So obviously a big upgrade in terms of financial strength, in terms of support. And again, this is all across the board in terms of yieldcos. And we do have a presentation on yieldcos. We have a large number in our Idea Vault coverage universe. And this is a group, I think, that has a lot of promise going forward in terms of yield, and as well as dividend growth, sustainable dividend growth going forward. So again, pretty nice opportunity area. And I want to just get through some of these opportunity areas before I give you a pick. But we do have a number of picks in the yieldco universe, and if you do take us up on that trial, we're happy to share them with you. You can take a look at what we have. But again, moving to the next, let's move to the next group. And the next group are master limited partnerships. So I talked about that, MLPs, and these are primarily oil and gas related, particularly in this index, which is the Alerian midstream, Alerian MLP index that's focused on midstream, AMZI. And so this owns primarily pipelines, some gathering assets, which are small pipelines that are close to wellheads, processing facilities, which in the case of natural gas, they remove the liquids that then are sold separately, things like propane or ethane. And they own storage systems, which are where gas or gas liquids are stored. Transportation, like pipelines, of course, the short haul pipelines within states, long haul pipelines. And midstream actually also includes things like ownership of liquefied natural gas export facilities. They were in this country. There's a number being built. One just opened off the Maryland coast. One is opening off the Georgia coast. A lot down in the Gulf Coast area. We're seeing some development facilities off the British Columbia in Canada. So this is a growing business, and this is an asset that tends to be heavily contracted, and that's really what these things are all about. Well, you can see that the history has been somewhat volatile recently, and this basically goes back 5 years. So you can look at that over at the beginning of the chart, just kind of following it across. When you hit a peak, that was pretty much where you had peaking oil prices back in the middle part of 2014. Oil prices started heading down, and it took a little while for these pipeline MLPs to head down, but then you came down to the middle part of or early part of 2016. Realization really hitting for people that, for investors that, that MLPs did have exposure to energy prices, though that was a pretty substantial decline. Well, we saw a recovery. One thing we noticed during that recovery was that a number of MLPs were actually reporting declining guidance, and in particular some of the ones that we like very much now, as they've taken their medicine. But at this point, they hadn't really taken their medicine, so we thought that recovery was something to sell into. We did pretty heavily in many areas, but now we've seen that what's happened since then. We've gotten a lot more bullish. We believe, and again, one of the things we do at Deep Dive Investing at our company is to get out and visit companies and particular conferences where executives and vendors and so forth of an industry will gather together. We found we get some pretty good insights. And this MLPs area, actually, we went to a conference back in June, and I put together a two-part report on that for Deep Dive Investing. The first one really focuses on some of the names that we had talked about earlier in 2017 when we first started, looking at the group and really trying to differentiate. And also in the water space. The second one looks at some of the more of the conference details and so forth. We've also done this for our Energy and Income Advisor subscribers, but this will be a slideshow presentation. Again, invite you to check it out. But we see MLPs as very much an opportunity area. The focus areas that we've had. One has been on the water side, and water, of course, hydraulic fracturing, just by the name, you get the picture, depends heavily on water. So water has become a big issue, and it's actually a very big growth sector for midstream companies. So another reason we're very bullish, in addition to the fact that we found investor sentiment to be very low. And I mentioned that conference, not just because we have a report for you to look at on the DDI website, but also because we believe it's kind of a turning point for MLPs in terms of investor sentiment. We've been going to this conference for, Elliot, a few years longer than me, but a great number of years. 4 years ago in 2014, compared to the conference this year, same conference, but about a third of the names that we had there. A lot fewer analysts, no lines for the coffee, which we kind of joke around as being kind of an indicator of how much analyst interest there is. If you have to wait in line for coffee, then odds are that there are a lot of people interested in the sector, and that was what we definitely found in 2014. Huge interest. But this year we never had to wait. Could pretty much just walk around anytime. And again, sort of a straw in the wind, if you will, but I think very useful to analyzing sentiment. And the irony is here you see, if you look at this graph a little more closely, you can see that the bottom that we reached this year, or the low that we reached this year, and where they're trading now, substantially above the low in 2016. But even though we're at a much higher level, the sentiment is actually lower, even though we found many companies have turned the corner, have taken that harmful, painful medicine and, cut distributions, reduced debt, sold assets, so forth, throttle back growth. Even though there's clear signs that the sector is a lot stronger than it's been in a very long time, certainly a lot less leverage than it was there at the top. Even though all these positive signs, you still have very negative sentiment. So again, we have some recommendations in those reports for you, and you can take a look. But these are, just getting back to, tying this into that larger theme that Elliot is talking about. This is kind of a way of getting ahead of the curve. MLPs are actually, being energy and being kind of tied into energy prices. This is actually a sector that could do very well the longer this bull market continues. They're very cheap. They're certainly priced at bear market prices, but we could see, and we believe we'll see we could see some substantial upside the longer this bull market goes on. If the bull market should be ending, though, you're now at valuation levels that are pretty typical of a much lower level for the overall market. So you could actually argue that they've already had their bear market. And while, as we've seen particularly in 2008, all stocks tend to get sold, on those really bad days when in a bear market, you're pretty good valuation levels, and particularly if you're looking out as income investors should. You're looking out 18, 24 months at minimum, possibly a little bit further. That if you buy at these levels, you're getting these yields and you're getting this dividend growth. And we're seeing dividend yields in this space, and you can see this in the report. Any strong companies yielding 5, 6, 7, 8% even, and growing those distributions as well. Although we've seen companies really throttle that back in the near term, they are actually those higher yields are actually safer because now we're seeing quite an extent of self-funding. So rather than actually have to access capital markets to build a pipeline or build onto a pipeline or build some sort of cash generating asset, these companies are actually able to finance that with their operating cash flow. So that's MLPs, very much an opportunity area in this latter stage of the bull market. A couple more areas just to take a look at for you. This is an area that we've had a lot of good fortune with. I read an article in the Wall Street Journal, maybe many of you did, a few days ago, and the article just kind of made the point that, look how terribly all these dividend-paying stocks have performed, and kind of the implication was, well, you better get out there and sell your dividend-paying stocks. And certainly utilities have been taken down recently, are still, even though we've had some rallying in the last few days. They're much lower. But if you look at this graph here, and this is Real Estate Investment Trust. This is actually an iShares ETF. So it owns the good and the bad and the ugly, not just the ones the stocks that we want to own. But if you take a look at this, starting from early February, very much in rally mode. In fact, this today actually broke up over 80. This ETF, so well above all these trend lines, and that's a pretty impressive rally. We have had some, we do have recommendations in this area as well, and in the Idea Vault as well as the Focus List, and this has been an area that's been very favorable for us. We also recommend a number of Canadian real estate investment trusts, and I just want to also mention that the first. I'm right now actually working on a presentation for Deep Dive Investing subscribers that is going to cover all these opportunity areas, and in fact a few more, with a lot of recommendations in them. So if you're interested in any of these opportunity areas, take a look at. Be sure you take a look at that report. Take a look at the reports that we have online for, again, not only U.S. REITs but also Canadian REITs. But as you can see, it's been a bullish environment. Again, this graph has probably not been posted on CNBC or certainly not in the Wall Street Journal. They were very adamant that all these groups had been selling off. Well, it's clearly since February we've seen a pretty strong rally in this particular group, and the reason is that they're tied into economic growth. Now, one of the consequences of this rally is that these REITs are at higher valuations now. So that gives us a little bit of pause, and we want to be selective in terms of entry points. We also want to be selective in terms of what we buy. REITs are a lot different universe than they were even 5-6 years ago. Many of the REITs that we have preferred in the last 3 or 4 years, few years ago, it was the data center REITs, are REITs that are kind of what we call unconventional. So not your standard office, retail, and apartment variety, although some of those can be interesting, but medical centers, or in one case, one of our recommendations, we've had the last couple of years has been a company that actually owns property underneath various facilities such as billboards or wireless towers. And actually, a couple of companies that do that under renewable energy facilities as well. So very, very kind of esoteric, but the key to all of them is that checklist that I presented to you over in the last segment, where you have dividend safety, dividend growth, strong balance sheets, lack of exposure to markets, cyclical forces, access to capital, and so on. So those are the companies we're interested in. We are still seeing some values there, but this is an area, again, that we see as an opportunity area. It's also an area that is doing well here in the latter stages of the bull market. So if you want to play on positive momentum, I mean, this is a pretty good group. And ironically, it's not a group that a lot of people are looking at right now. But real estate is definitely an economically sensitive area of the economy, and that's what really drives REITs at least on a yearly basis. Is how healthy is the environment for rents and vacancy and new buildings, acquisitions, and so forth. And right now things are pretty good for the group, though we're with our recommendations, we are going to be quite selective. So the last opportunity area here is utilities, and this isn't really a focus area so much for deep dive investing. We do have a Conrad's utility investor that focuses on these in much more detail. But we also, again, deep dive investing is a broad-based focus. So we do look at companies within the sector. This is a longer-term graph than I was showing for some of the other areas. This is actually a 5-year graph, so you can see it's been a pretty bullish 5 years for utilities, and that's despite the fact that in May of 2013, that's really when I count the change in the interest rate cycle, because that was the point where the Federal Reserve said straight up, no more quantitative easing. We're going to start shrinking our balance sheet. We're going to start ratcheting or normalizing the Fed funds rate. And the result was, or the immediate impact was quite substantial, and we saw the 10-year rate head up pretty dramatically. We did see some selling in groups that many investors consider to be interest rate sensitive, so kind of that money sloshed around. But generally, there was the decline in the sector was very temporary. And you can also look at since December of 2015, that's when the Fed actually started raising the Fed funds rate. And you have a positive result for the utilities. So, I showed you that graph a little bit earlier about how utilities have not done so well over the past year, how that contrasts with what actually happened in 2008, and the very strong likelihood that this is one group that has been caught up in algorithmic trading to a large extent with the ETFs. Certainly you see that in some of the volatility. The opportunity with these, though, is looking for companies that fall back to trade at valuations that we would consider very, very attractive in terms of potential growth and yield. And again, that's kind of the group that we're looking at. And my recommendation for you today is actually from this group, and it's actually in our on our focus list, and I think it's the subject of the next slide here, and that's AltaGas. So AltaGas is actually a Canadian-based company. Its home market is in Toronto. It does trade a 5-letter symbol, which is what is graphed here to the right, and it's a 5-letter over-the-counter symbol with a reasonable amount of liquidity. But I also think, and if one of the things that's actually one of the potential catalysts for this stock is a potential New York Stock Exchange listing. This has not been announced by management. It's not, been talked about. But on the other hand, we have seen a number of Canadian companies that have made acquisitions here, Fortis and Algonquin, for example. They have listed New York, and they've gotten a nice boost in their share price. So that's a potential catalyst. Why would they list New York? Well, because they are on the verge of closing the merger with a company called WGL Holdings, which is actually the natural gas utility for where I live in Northern Virginia, also for Washington, D.C., and also for Maryland. So they've had to get regulatory approval in those three areas. They're still waiting on the District of Columbia, but that appears to be moving forward. Looks like in stark contrast to what we saw with Exelon when it bought Pepco Holdings a couple of years ago. The regulators are trying to move it along and get this thing closed. So what happens when that happens? Well, this company suddenly becomes much more of a U.S. Based company than a Canada-based company. It has a lot of, it will have its hands in a lot of midstream infrastructure as well as these natural gas distribution. Utilities will be the core of the business when the deal does close. AltaGas owns a number of natural gas utilities in the U.S. and Canada, primarily smaller ones. WGL will be the largest. But they will have a very large base of very secure revenue, which combined with that high credit rating you see there, and what's already a pretty low cost of long-term debt, you can see that also in that kind of fact list there on the side there. The yield to maturity for their, and this is the return for somebody bought those things, but for their bonds maturing in 2047, it's only about 4.6%. So that's very low cost money. The stock itself yields about 8%, loses a little over 8%. It's growing at a mid-single digit rate, which it's already talked about ratcheting up into upper single digits when it is able to close the WGL merger. So that closing the WGL merger is a very important potential catalyst for the stock. You can sort of see how it's ratcheted up there at the in the latter weeks of this chart, which is a one-year chart. That's in anticipation of this thing closing. Other things they have going for them, they are building liquefied natural gas and natural gas liquids infrastructure on Canada's British Columbia coast, and those projects are moving forward to bring out what is now very cheap and landlocked gas in the Montney Shale, which is in northern British Columbia, as well as some of the other finds there. Very much a very low-cost reserve there of natural gas, and AltaGas is helping to get that to the market. Those projects they take a while to build, not just for the fact that building a pipeline takes a while, but also to get regulatory approvals, get them through the First Nations and so forth. But those seem to also be moving along. I mentioned Canadian dollar as a potential catalyst for the stock. Canadian dollar has been weak against the U.S. dollar with some of the trade noise. But we believe that, again, this country rather, is, its economy is growing as commodity prices have strengthened. The oil business has strengthened. That's very much a plus for them. Again, it's hard to ignore some of the noise about NAFTA, some of the comments that are made and so forth. But in a typical cycle, Canadian dollar will do well. And this stock is still primary market being Toronto, priced in Canadian dollars, pays its dividend in Canadian dollars. So, and you're starting from a pretty low point, about 74 US cents right now for the Canadian dollar. So, and by contrast, a few years ago, it was at over parity. So, a lot of potential upside here for that. And AltaGas is one way you can benefit without, while picking up a nice yield that's growing. And again, as I mentioned, after they complete this WGL deal, which I think will probably be the first big catalyst we see for the stock, possibly it will become very much much more of a U.S. company. And Canadian dollar or a New York Stock Exchange listing has been given a pretty nice lift to other Canadian companies that have made acquisitions in this country. So it's also a focus list stock. You can look at it there. You can look at you can see what I've written about it in Idea Vaults under gas midstream, and that's all I have. Again, I appreciate everybody tuning in, and hope you like those. Hope you like those recommendations. But I think Elliot, you want to talk about this our offer here? Are you on, Elliot? Well, I'll just until you come in, I'll just talk about this. This is kind of the main points of this, what we have here. You can see this is not, this is a pretty good, we're lopping off quite a bit off the price of this product. It's a 60-day risk-free trial, which means that, you do have the right to cancel over that period, and with risk-free, meaning that you get all your money back. Our offer does run through this weekend, so if you want to take some time to think about and look at the slides here again, feel free. We do have a focus list, and I think Elliot mentioned it. Our new managed model portfolios. He mentioned the growth. We are also putting together an income managed model portfolio, and what this means, I'll just mention briefly, is pretty much a dollar for dollar telling you where to invest things. We look at things through, very closely through the prism of, risk management and value at risk and so forth. And in an income portfolio, of course, the two big risks are, duration, which is interest rate risk, and credit risk. And we will, this managed portfolio, while we won't be, trading it heavily, I think it will give us a nice edge here in this environment. Are you back with us, Elliot? You want to?
Yeah. Can you hear me? Can you hear me now?
Yeah, I can hear you. You can.
Great. Yeah. I don't know what happened there with my microphone, but absolutely. As Roger said, we are offering through this weekend 25% off a risk-free trial to the service. You have to use the code there, VIP 2018, which you see on the slide. We do have what we call our forever guarantee on all new subscriptions. What that means is that if you sign up today, either at our annual price, which is $11.25 in this case, or at a quarterly rate of $500 a quarter, your rate will never go up. So if you choose to renew in a year's time, your cost will be the same $11.25. It won't be whatever new subscribers are paying, which right now is $1,500, and we are looking to possibly raise the price on this product next year. Right now, deep dive investing has proven very popular for us. We launched it a little over a year ago to a fairly small list of readers who kind of helped us beta test it and work some of the kinks out and add a lot of new features. And we're now rolling it out to a wider audience. We think it's a critical time for this product, for this service. As we kind of explained, we're very worried about the market valuations we're seeing right now. Very worried about that we're entering this very treacherous period in the stock market cycle where we transition from a bull market to a bear market. I think a lot of people that are in index funds, et cetera, are going to get kind of caught up in this, and you really need to start preparing now. And that's why we want to offer, we're calling it our bear market survival offer, a 60-day risk-free trial. Sign up today, check out our service for 60 days, and if you're not 100% satisfied, you can cancel anytime and get a full refund. So that's the offer we're giving right now. The easiest way to take advantage of it is to go to that website you see on your screen, the https deepdiveinvesting.com, Death of the Stock Market. We do have a detailed report up on that website. It's an open letter, completely free to read. Has a lot of the charts and data that we presented to you today. Some of the key steps that we're recommending right now, as well as it's the only way you can get to take us up on this risk-free trial offer via the internet. The alternative would be to call our customer service manager, Sherry. There's the toll-free number on the screen, 877-302-0749. She's available from 9 a.m. to 5 p.m. Eastern Time. If you call her, please be sure to quote the code VIP 2018 to her to make sure that you get all of the bonus offers and reports that we described. So check out our website, check out our open letter, or give us a call or give us a call. One more thing, for those of you who are on the call tonight, we have decided to give a special unannounced bonus to those of you who are attending this webinar live. It's only open to those of you who are attending live. And that is, if you choose to take us up on our 60-day risk-free trial offer. Again, we're asking you to give it a try, not to commit. If you don't like it, you can always cancel. But if you want to take us up on that annual offer at that 25% discounted price, we will also throw in a free 1-quarter trial offer and subscription to our Energy and Income Advisor service. We've never offered this before. Normally, a quarterly subscription to Energy and Income Advisor would cost $194. So that's an additional $194 value. It's only available to those of you who are listening to my voice right now. We want to give you a little something extra, something we're not announcing. It's not on the website page you see. But if you'd like to take us up on that annual offer, either via the website or over the phone, Sherry tells me she'll set you up with a free 1-quarter trial to our Energy and Income Advisor service, which gives you a lot of coverage on MLPs and energy stocks, which we think are a great place to be right now. So with that in mind, please feel free to ask any questions you'd like. Excuse me, you can type your question into the Q&A or chat box on your screen, and we'll answer a few questions tonight if anybody has any. Otherwise, if you think of something later, feel free to drop us an email at the email address on your screen, and we would be happy to get back to you with an answer. As I said, this whole webinar strategy session has been recorded, and we will send out a link to the slides and the recording probably tomorrow morning. It's almost 9 o'clock here on the East Coast, but we will have it in your inbox tomorrow morning, so you can listen to it at your leisure. So with that, let me just give everyone a few minutes. If anybody has any questions to ask, we'd love to answer them right now. Well, maybe we did a good job, Roger, of answering everybody's questions during the course of the webinar. I don't see any questions on my screen. If you have a question, just go to that Q&A box at the top of your screen there. It says Q&A, has like a little picture of a folder with a Q on it. Type in your question, and we will answer it. There we go. I think we got one.
All right.
Yeah, we have a question about, I think this is one you cover, Roger, PBA.
Okay.
Pembina? PBA, is that Pembina?
Oh, yeah. So Pembina is obviously, we actually cover it in pretty much all of our publications. It's a name I've been looking at for about 15 years, I guess, dating back to when I was at our former publisher. We used to do a thing called Canadian Edge. And Pembina is kind of unique in the midstream universe in that it's pretty much a all Canadian midstream company. If you look at the other two big Canadians, TransCanada and Enbridge, they have assets that kind of straddle both sides of the border. I think what that has done for Pembina, actually, one thing, it's kind of never mentioned even in the same breath with the other two, but I think this is an extraordinary value. I mean, this is a company that has successfully made acquisitions. It's successfully built, various infrastructure. It's got its hands in the oil sands, which I think could really benefit if some of those big long haul pipelines come out of there. But in the meantime, they've been doing very, very well with a wide variety of other types of projects. So they've just completed a major capital spending program that has dramatically increased their EBITDA, or earnings before interest, taxes, depreciation, amortization, kind of shorthand for cash flow, and it's kind of put them in a different category. So they're you're seeing upper single-digit dividend growth there. Of course, they pay monthly, really based around a very solid amount of assets. And the fact they've done so well, even in an environment where Canadian energy has been to a large extent locked in by the lack of off-taking, lack of big pipelines coming out of there. If we do see some of those big pipelines built, they are very well positioned to benefit, and they're not really exposed to the situation if if those pipelines take longer to get built than it looks like even now. Which you have to wonder what's it going to take to build one of those things. Well, it's perhaps the Trans Mountain. The government really wants that one to go through, but we'll see what happens with those. But in the meantime, Pembina has been doing very well. They have a very solid growth plan. They have a 3-letter New York Stock Exchange symbol, which makes it very convenient to buy, and home markets in Toronto, and they pay dividends in Canadian dollars. So it's a play on the Canadian dollar as well. But which is, as I indicated with AltaGas, is a positive. But I think this is definitely a very solid buy. I've rated a buy up to 35. Again, it's been in the Conrad Utility Investor, Energy and Income Advisor portfolios. We have not covered it to date in deep dive investing. That's definitely an area that we could take a look at, though it's more the purview, I think, of Energy and Income Advisor, which I think you mentioned that if somebody was interested, and particularly interested in Canadian midstream or U.S. midstream, we just did a big thing on MLPs. We're throwing that in, as I understand you, we're throwing that in as well if you take us up on our offer for
yes.
deep dive investing. So.
A little something we wanted to throw out there as a sort of unannounced bonus for those of you who are actually attending live on the call tonight. We do have another question, actually, kind of. I think next couple questions actually are kind of related. The first question is: as a Canadian investor, what are the currency risks, advantages? I know, Roger. I mean, you cover some, as you mentioned. On your presentation, your prepared.
Well, that's a really good question. I mean, because I guess what you're asking is, what happens if you're a Canadian investor, you invest in the U.S. with the Canadian dollar at such a low rate? What happens to your U.S. dollar dividends, say if the Canadian dollar, rallies, which I guess I pretty much said is what I kind of expect over 18, 24 months. We definitely have had it follows energy prices pretty closely, the U.S. dollar Canadian dollar exchange rate. So that tends to vary, but being generally bullish on oil, and also if those pipelines are built, there's a pretty good case that there's going to be a lot more Canadian energy going international markets, which is good for the economy, which is good for the currency. So what happens to your U.S. investments when the Canadian dollar rallies? Well, I think you just have to kind of do what I've done or what I've advised U.S. investors on, over the last several years. Is the growth opportunity, the income opportunity in the U.S. worth, the currency or the likely currency headwind? I mean, we haven't had the currency headwind yet, frankly. So, if we do get, more craziness with trade and so forth, the Canadian dollar could come down another couple of cents. So that would be good for you investing in the U.S. But I think the real question is, or that to ask is, again, are these individual investments, is the dividend yield, is the dividend growth, is the capital gains, worth the potential headwind? And I think, I think that the sectors that I've outlined for you are definitely qualify in that regard. They're very attractive, regardless of what you're investing the currency in and so forth. So, I mean, but that's a very good question. And again, it's sort of the mirror image of what U.S. investors have had to look at when investing in Canada. But it has been the picks that we've had, like Pembina, for example, which was the previous question, they've done very well for U.S. investors in spite of the currency headwind. I think, wise selection, we can pick out a portfolio that and that will give you the opposite kind of kick. And if you have again, Canadian companies investing in the U.S., that's another factor because, it depends on how well they hedge and so forth. But there are natural hedges, for utility companies investing south, meaning that debt denominated in U.S. dollars, interest payments in U.S. dollars are worth less if the Canadian dollar rallies. So, again,
you actually got the flip side question here. You got a question.
Yeah, that's really interesting.
Strong dollar about how about Canadian banks and Bell Canada, I guess, from an American investor standpoint.
Yeah, I mean, we used to have, when I did the Canadian letter, I did have, I guess, a fair number of Canadian readers, maybe about 20% or so. And investing is becoming international, and currency is, or it has long since become international. Currency is important. But I think, the broader point is just, and what we discovered with the Canadians and the Australians that we've had in our various advisories and so forth, if you have a quality company that's growing, that currency risk is a relatively minor factor. I mean, it's a nice kicker to have when it's going your direction, but it doesn't, ruin the value of the investment if you've chosen well.
Yeah. And the question here about Canadian banks, I actually looked at a whole list of Canadian banks and also European banks when I was doing, fundamental work on the financial theme. And we do believe there are a lot of financials that benefit from rising interest rates. And I think one of the things that's kind of interesting about the United States and kind of unique to the United States, I would say, is that we have a ton of little banks. In Europe and in Canada, the market's dominated by a fairly small handful of banks. I mean, in the United States, there are literally hundreds of publicly traded banks. Some of them barely trade, right? But, all over the country. And that's one thing that really attracts me to the sector is, again, we were talking about earlier, when you have so many different small companies out there, it's a lot easier to find names that aren't being widely looked at that could be in, like, for example, I think FCB, the one I mentioned, is a likely takeover target. We've been saying that for a while. They actually announced that they're exploring that if there's any interest in buying them, and I think there will be. There are just a lot of little small markets, niches, companies that most people ignore because they're too busy, following JP Morgan or Citigroup or something. That that there's a lot of alpha. There's a lot of potential returns there. Looks like the next question here is, I missed the first 45 minutes of the presentation. What are your thoughts on today's nosedive? Is this random noise or potential short-term trend? I'm guessing you're talking about the broader market there. Yeah, I mean, it was, we've seen this kind of weird thing really over the last week or so where most days the market's been weak at some point in the morning and then we've closed pretty strong, like kind of flat, like we did yesterday, for example. Today we saw the opposite. Things were kind of holding up okay, and then at the end of the day we had a sell-off. I wouldn't be surprised to see in the really short term, a little follow through on the downside over the next few days. However, I do think, based on the indicators I follow, that it's really a question of when, not if, the S&P 500 breaks out to a new high. And the main reasons are, the U.S. Stock market very rarely tops out more than a year before the U.S. economy enters recession. And there's just nothing in the data to suggest that there's any risk or any significant risk of the U.S. There's always some risk, but any significant risk of the U.S. economy entering recession over the next year. The other thing I'd look at is, look at the small caps, right? Today they were down. Today the Russell was down actually a little more in percentage terms than the S&P, but it's been just breaking out to new highs just a couple days ago, even as the S&P 500 has kind of lagged a little bit. So that would be very unusual for that to be the case ahead of a bear market for the S&P. Historically, when that happens, the S&P 500 ultimately follows suit. Also, look at technology. Look at the NASDAQ. All that stuff is breaking out. A lot of these small regional banks that we've talked about, those are also breaking out. Typically, those little banks don't do that well when the economy is sort of topping out, or there are real concerns about interest rates maybe falling instead of rising. So I think you could see some follow. I mean, my view is you could see some follow through given how nasty the sell-off was late in the day. But I still think that you've got more headroom in this bull market. But we are, look, 9+ years now. The economy has been growing for 9 years too, right? Since June of 2009. Another year will be the longest expansion, the longest bull market in U.S. history. You got to think we're getting close to the end. Bull markets don't die of old age, but we're seeing all the signs: rising inflationary pressures, wage pricing pressure, outperformance of energy stocks of late, outperformance of basic material stocks of late. We're seeing flattening yield curve. Almost always happens in the final part of a bull market. Volatility picking up from last year's sort of lethargic level. I can tick off the list for you, but these are all signs of a late cycle bull market. And I think we're there. We're probably, within 12 months of the top. And so, it's not time to sell. As I told you, selling too soon is even worse than selling a little bit too late historically, but it is time to get prepared because bear markets are coming. And when they do, given the valuations that are out there, I do think you could see the stock market down. It could be very nasty, especially in some of these names that are trading at valuations that are kind of hard to justify on a fundamental basis. I mean, I look at Amazon.com. Look, I love the company. I use their product, their service all the time. But, 147 times forward earnings, in what world does that make a lot of sense? Technology being 27% of the S&P 500 and energy being 6%. These are 30-year stretched levels on the upside for tech and on the downside for energy. That CAPE ratio I showed you, market could go down 50% eventually and still be just fairly valued. Looks like we got another question for you, Roger. Do you still like AQN?
Yeah, I think that's Algonquin Power and Utilities. I think I mentioned that. One of the interesting things that about that company is that it's the new sponsor for a company called Atlantica Yield, and Atlantica Yield is a yieldco, so it's part of that index that I showed you in the presentation. And its former sponsor was a company called Abengoa, and in fact, the yieldco itself was called Abengoa Yield. And what happened was Abengoa is a big engineering company in Spain that got very over leveraged. And one way they thought they were going to be able to bring that leverage down was to drop down various projects that they had that were under contract to Abengoa, which is now again Atlantica. That model became more difficult, in part because Abengoa the yieldco came down, and they wound up, Abengoa, the parent, wound up going bankrupt. So after a lot of negotiating, I guess, bankruptcy court type activity, they sold their ownership interest about 41.5% to Algonquin. So Algonquin has this asset, again, at a pretty good price. They also have a joint venture with Abengoa now, the engineering company, to build various cash generating infrastructure around the world, some solar power, some transmission lines, some water, and so forth. So those are the assets that are going to be dropped down to Atlantica. And that's really been the shot in the arm that this yieldco is needed. Just a supportive sponsor that is able to drop down assets. And as they do so, the yield goes up, and of course, Algonquin benefits from that. So Algonquin, by making this purchase, has expanded its range outside North America, and it's also done it at a very good price, and has established a venture to grow this. So it's a new income stream for them, in addition to what you see them doing with their U.S. utility assets, as well as their independent contracted power assets, which are primarily wind and so forth. So there's a lot going on there. This is a company that I knew back, I guess 10 years ago, back in the middle of the last decade, when it was an income trust. And they converted to a corporation. They cut their dividend pretty substantially. At the time, really turned off a lot of people. Actually, when I saw this guy the CEO at the Edison Electric Institute meeting a couple of years ago, I asked him about that, and he said, he had a joke for me. It's like, oh no, you're one of those guys. And I said, well, it looks like you guys have turned things around here, and which they have. So what they did basically is, they, instead of paying out all their income and dividend, all their cash flow and dividends, starting in about 2007, they've been investing that money. So now they have a company that is growing its distribution about 10% a year. That looks very sustainable to me, and they're doing it in several different ways that are well within their comfort zone. So it's a nice situation. It's one of those that did get a boost when they completed a merger with a company called Empire District, a big utility in the middle of the country, assets in Missouri, Arkansas, and so forth, the Ozarks, that region. And that made them much more of a U.S. Focused company than a Canadian company. Also gave them a lot of financial ballast, I guess you could call it, to grow the rest of their business. And so what you have is a utility that has a long history of being a successful independent power producer and contract power producer, and really tapped into a lot of things that are, I think, going to generate very strong growth going forward. So, yes, I think it's a strong buy here. It's retreated a little bit with the rest of the utility space, but I don't know how you call a stock that's growing its dividend 10% a year, has been doing so, and has a pretty clear pathway to doing so. I don't know how you call that interest rate sensitive. It's one of those quirks about the market, but on the bright side, it does give investors who don't have a position a good opportunity to pick up some shares. It's one that we cover in Conrad's Utility Investor primarily. But again, like I said, we do one of the themes that we've had in deep dive investing has been the yieldcos, and they're very much a player in that. So that's all I have to say about that, as Forrest Gump would say.
Yeah, it looks like the next question here is asking about that. AQN. So the ticker is AQN, and that's Algonquin Power, right?
Right.
And they're asking, is it Canadian or is it American?
It's well, the home market's Toronto, so it's AQN is also the symbol there, but it's a New York traded stock. So
so
you
take
have
your pick, basically.
Yeah, take your pick. I mean, if you're a U.S. investor, it's probably easier to buy in the U.S. But that's that one. Again, it's and it's primarily, like I said, it's earning most of its revenue in the U.S. Atlantica does open up a number of other markets because Abengoa was an international company, particularly a lot of presence in South America and also Spain. So by tapping in Atlantica has actually assets in South Africa as well. So they were all over the place, but in good projects. You can look on their website. You can see, and we've done this in presentations as well. You can see where those assets are and how they're backed by various contracts. Talking about Atlantica, but Algonquin, again, they're going to realize quite a bit of that benefit, and they really have, again, three real drivers of growth. They have, the Atlantica investment. They've got the utility, which they're actually spending a lot of money upgrading the grid and putting in, replacing aging coal-fired power plants in Missouri. That's a big part of what they're doing. That's driving their rate-based growth. At the same time, it's driving down operating costs. So, if you make investments that drive down your operating costs as a utility, you can increase your earnings even as you cut customers' rates. So that's a pretty nice dynamic, and they're very tapped into that. The CEO is very engaging. I've always have a good time asking questions.
Great. Well, it looks like that's all the questions I see in the on the queue here tonight. So it looks like we're already 15-20 minutes over the time. So I guess we'll wrap it up. I know we covered a lot of ground today. Again, I know we had a question from someone who said they missed the first 45 minutes of the presentation. Don't worry too much, because we will send you a link to the recorded version of the presentation probably tomorrow morning, along with the slide deck in PDF format. You shouldn't miss anything if you want to watch it on the recording. If you have any questions that come up later, feel free to drop us an email. We look forward to, check out our open letter at deepdiveinvesting.com/death of the stock market. If you'd like to take us up on our risk-free trial offer to give Deep Dive Investing a test drive, we're very excited about, we've had some great returns for the product, for the service over the last year and a bit. And we're really excited about the opportunities as we enter this sort of more volatile final stage of the bull market. We'd love to welcome some of you on board as trial members. And again, we are offering through the weekend anyway, an additional 25% off that annual rate using the code you see on your screen, VIP 2018. So with that, thank you all for listening to us tonight, and we look forward to welcoming you all on board as subscribers.
Thanks, everybody, and check it out. If you check out Deep Dive Investing, you can look at everything we've done. You can look at the Idea Vault, the focus list. Give it a test drive, as Elliot said. Thanks for tuning in tonight, and hopefully we'll be talking in the future.
Good night, everyone.